It's Julian Cater from Canaccord again. Two questions, please. On the international support services business, if I look at actually one of Adrian's slides, the workload went backwards in 2012 on 2011. You obviously bought Toco at the start of this year. Could you perhaps update us on what the sort of pro forma workload of that business would be now post that acquisition? That's the first question.
Toco's turnover is
$70 million.
yeah, and that's basically full for this year. We get 85% of that consolidated, so that would be a straightforward addition. The rest of the business is holding up pretty well. I mean, it's a combination of contracts and framework, so we have to be a little bit judgmental as to how much will fall into what year. We did suffer a little bit last year with some shutdown work for Rasgas moving into 13 from 12, but that's this year's benefit, I guess. So
okay, thank you. And my second question is on the equipment services. You've moved £40 million worth of kit last year, which I believe that's probably 35% of the overall fleet value within that business, which seems like a very large number. Are you seeing a sort of demonstrable benefit in terms of utilisation levels in the sort of first part of this year as a result of that fleet movement?
Well, we'll update on trading at the trading update, but we did it for good reason.
I'm happy to as well. I think it's about a quarter of the fleet in the way that we value that. We do see, from a revenue point of view, that if we hadn't moved that equipment, the revenue wouldn't have been generated. And we do have confidence that where it's gone to, which is basically a lot of it's gone to the Far East, we do see that activity continuing. So if we hadn't have moved that, we wouldn't have captured the revenue. From a utilisation level this year, I think, as Adrian said, we'll talk about that when we do a trading update for later this year. But the confidence in moving that utilisation towards that 50% and above is part of what we're doing. And we've moved, I would say, not the same value, but we moved an appreciable amount of equipment during 2010 and 2011 as well, mainly moving that out of Europe as part of the downturn of Europe.
Thank you.
Thanks, Stephen Rawlinson. Can I just have a look at the Construction International piece? I mean, in the early part of the presentation, Adrian, you said that I think that there were signs of improvement, and yet actually in the presentation that George gave, he said the market remains tight, and the signals of the three areas there didn't look particularly positive. The margin's gone from 10, 8, 6. What's to stop the margin going further downwards, and at what point do you actually take a view on that business?
Yeah, I don't think a market being tight and there being signs of improvement are contradictory statements. It's a tight market, but it's not getting tighter. In fact, in the UAE, there are distinct signs of improvement, but that's orders secured. That's got to be built profitably and cash collected yet before we would declare victory. So there's a way to go, but we're certainly on a improving trend, albeit from a low start. Margins, yeah, I mean we did very well in a good market. Margins are tighter. We think there are good reasons why we should expect to see margins in the region remain above those that we would traditionally sort of expect in Europe. And George touched on, I think, what's the key point there, which is there's a natural choke on the supply of labour in these markets. The visa control is very strict. If you're running a country such as Qatar, and we alluded to the way that country is run, if you're outnumbered 4-1 by foreigners, you probably don't want that to be 5 or 6 or 7-1. So there is a sort of a natural choke on the supply side of the market. Labour-intensive industry, more labour-intensive in the Gulf than in the UK. There's labour's cheap, so there's not that much need to, relatively cheap, there's not much need to sort of invest in technology that displaces labour. But when you've got it, and demand's rising, it's like any other leveraged product. The price will increase. And looking into rising demand outlook, as we believe we are, question mark the precise timing of when that increase arrives. I think we would take the view that we've probably reached about the bottom of the cycle. We were 6.5%, I think. Last year we said we'll trade around 6%. And we would still hold to that sort of broad outline and think it is logical and rational to expect it to stay there rather than just a pure hope play. But clearly, all this performance stuff is subject to us continuing to execute properly. Like anybody, we can have a bad contract. We don't think we should, we don't think we will. But that risk, does exist in the mix. George, is there anything else about the countries in particular that you would point to talk about the margin?
Qatar, if you actually look at the sort of market dynamics, the construction output in Oman was about 3 million in 2011, and awards 3 billion. Sorry, beg your pardon. This is dollars, and awards were 6. Qatar was something like 6.8, and awards were 8. UAE was 21, and awards were 40. Saudi was 19.7, and awards were 59. So you can see that the backlog, in particularly in the UAE and Saudi, is starting to grow quite quickly, and Qatar is struggling to get its act together. It will do, though, over the next couple of years.
Thanks. Andrew, and then Mark. Perhaps Mark you first, and then we'll come to Andrew.
Yeah, could I just sort of follow on Qatar? You very handily put up a slide of oil demand, but sort of it'd be useful to see. I mean, I'm not an oil and gas analyst, as you probably guessed, but sort of analysis of sort of gas supply versus demand. I mean, you're talking about sort of Qatar doubling its own sort of field capacity, and then there's a lot of shale gas reserves coming on in the Western world, and this is causing the gas price to fall. Is Qatar? Are they sitting up? One of the biggest source of revenues. I mean, they're a wealthy enough country as it is, but are they looking at that sort of before spending the money on the projects that they're scheduled to spend, saying, well, let's just see how this pans out, guys, before we push the button on all this spending? Or is that just like, is it inconsequential and there's no problem
I think the next big development in Qatar is going to be downstream. So it's they're going to put in a polyvinyl plant or the likes. They've already got their infrastructure in place. They can get their gas out of the ground relatively cheaply. So I think that they can respond to any changes in market price.
I really mean if obviously they're getting a percentage of the revenue for what's coming out of the ground. If the price is falling, then their revenue for government revenues will also fall. So their ability to spend on infrastructure, not necessarily oil and gas related infrastructure, but everything else will fall.
I mean,
so that's what I'm asking.
From memory, I think the Qatari budget works on about a $40-odd oil price equivalent in gas. So you've got a lot of headroom.
All of these economies work on a much lower price than they're actually getting for their oil and gas.
So I think you can't deny the risk, but there's a lot of tolerance to take that risk before it, I think, really bites into the here and now. To the extent that knocks confidence in terms of investing in their own backyard, I don't know, but I think the Qataris have put themselves in a very high-profile position in terms of the world media arriving in their country in a few years' time for a football tournament that they will not want to disappoint with. And whether it's a sort of a long-term sensible investment or or proves to be a sort of a very expensive piece of window dressing, only history will judge. But I think substantially that investment will take place in order to deliver that event as a successful sort of media outcome. And this is much bigger than a few football stadiums, as we've sort of rehearsed. And you've seen the models, Mark. What we want to see, obviously, is the holes being dug and the real thing being built properly. And we can sort of sense that now coming a little bit more with R&D, perhaps in the first instance, than with our construction business as we get involved in heavier infrastructure earlier in the cycle there. And you're starting to see a bit of that demand pull through manifest itself now, Ian, I think.
So just related to that, are you saying that Qatari projects will start to come out for tendering at the end of this year, or is it now slipped into 14? Because I remember a lot of us went over there to look at Qatar, I think 2011 as an opportunity, and it's seems to be waiting.
Yeah, we've currently got submitted, awaiting a result, 6 billion Qatari in tenders from Gulf Contracting. So
there are projects out there already. Decisions haven't yet been made finally as to which will go and who will carry them off. But there's plenty of activity at the front end of the market. This needs to be converted into contract signatures. But we suspect it will be. Andrew, you had your hand up from the word go.
Andrew Nussey again from Peel Hunt. A question for Ian. You highlighted return on capital as one of your financial metrics. I just wonder if you give us a feel how that changed over 10, 12, and possibly your aspiration for 15.
Yeah, I might get some help from Tim on this one as well, but the I haven't got the figures with me. Actually, I have got the figures with me.
Through the cycle, RMD chips in mid 20% return on capital employed, which puts it pretty much in the pack with the rest of our divisions. And I think at the bottom of the cycle that had fallen to sort of mid-teens, and at the very top of the cycle it was approaching 30%.
And we look at when the point I made when I said we review our businesses in line with that. So a lot of our businesses go up and down as markets go up and down. And we look over a 3-year period for each business to see whether there are plans to get back to our target ROCE, which is different. It's in a band, but it's different by country, whether they can get there or not. And that's part of how we put our plans together.
And secondly, we hear a lot about integration. I just wonder how integrated construction and RMD can be in terms of tackling customer projects.
Well, we do. That picture of JBR that I put up in the UAE is using RMD equipment. So wherever we can, we'll use our sister company too.
So the way that works, sort of from, because we're a sales, we're all businesses trying to generate revenue, but we're a very sales-orientated business. So we're aware of the fact that our sister companies need to be able to go to the whole market to get their supplies. So what happens in the UK and in the Middle East is there's a lot of communication. So we will be given information around when projects are coming along. We won't be given any sort of special treatment in any way other than by availability of information and access to people. And then what we ask for is to just give us that information so that we can then go and try and win that work. And I think that works very successfully in the Middle East. There's less work in the UK, a certain amount of subcontract business in the UK. But with Ian Renard, who's George's opposite number, he's forced through 2 or 3 subcontractors to actually make sure they will price from us. And we've won all of those projects then on our own merits, that we don't expect a decision from Interserve to make that happen.
And to be fair, in the UK, the average contract size that we're delivering as a construction contractor is smaller and a bit less formwork intensive than it would be, say, in the Gulf.
I've grabbed the mic. Andy Brown again. On international support services, I think you gave us in the small part a margin of 10%. You also showed us the potential to add more services there, which I guess would be the lower margin. So is the aim to try and develop the business and keep the margin, or broaden the service range and just grow the top line?
I think we're capable of demanding reasonable margins for that full range of services, because a lot of them are single service lines which can be consolidated into a total FM package, like the one that we're providing for TDIC. There is a range of, on average we're producing 10% plus, and there's quite a wide range. Royal Palaces come at a nice premium. So yeah.
I'm not sure we're necessarily selling down the value chain when we're expanding the business.
No.
Yeah, thank you.
Howard, and then Kevin.
A couple from me, please. Howard Seymour from Numis again, and it's on equipment services. Firstly, just a question on, you mentioned Europe about taking costs out on the equipment services side. How do you take costs out of the business? Because I assume the kit is the kit. Is it people closing offices, etc.?
Yeah, so perhaps I'm not sure what's public and what's not, but it's in history that we've taken out of our 3 businesses in Spain, UK and Ireland. We've taken about 200 people out of our businesses there since 2010. We have done definitely in Spain. We've closed offices and we've renegotiated rents where we can. And then from a business generation point of view, obviously it has a minor impact on the local P&L, let's say, in Spain. But we've moved that equipment, which takes that charge away from Spain and actually gets deployed somewhere where it's going to generate some revenue. So we are pretty much split equipment, people and property. That's our cost base. But we have taken really major actions.
I might just add one supplementary point to that. Some of that is removing activity from the cost base. Some of it is transferring it. I alluded earlier on to having relocated some of our back office processes. Ian's built a very capable and growing design office in the Philippines, in Manila, where we are employing highly competent graduate engineers with a great attitude towards what they do for 20% of the price we would pay in Europe. Phenomenal output, and servicing 5 countries out of that Philippines engineering hub. So much lower cost base, much higher quality output, better learning environment, but displacing fixed cost out of a market that's struggling.
Okay. Second question was on the sort of the bigger strategic model, because you mentioned going into new markets using the utilisation, the capacity from elsewhere. Just intrigued on that, because if your utilisation is 50%, you move say 20%. Do you need to invest in new kit, or can you get the utilisation up by moving more of the kit across the world over time? I mean, is 55% the top, or can it go above that?
I think from my experience, looking back in our history, that mid-50s is really the ceiling level. If you have less branches and less locations, you can get utilisation higher. But when you've got 50, 60, 70 branches around the world, and sectors tend to operate in slightly different ways for commercial versus infrastructure, it's very difficult to get past that mid-50s. For us going forward, I think we'll continue to put pressure on our businesses by moving the equipment if it's not being used. But I think I said we will be investing in the fleet now, or we expect to from now until 2015. And I think there's some guidance out on the amount that we'll be doing that as well. Yeah. So it's a combination of both, I think.
And when you invest in the kit, is that because it's going to be new kit into, say, the commercial sector or the infrastructure, or is it just into new markets?
It's never either one of those. So it will be, for instance, even in an existing business like Hong Kong, where there's a lot of activity, it will be about needing additional equipment because we haven't got it either spare around the rest of the world or in play in Hong Kong. Then we'll take a view of, well, are we just making equipment for a small peak, or is there sort of longevity of that? That's one way. Going into the new businesses like Colombia, Panama, moving some equipment to Poland, we've done that with existing equipment. We're not invested at all for that. And that was a way of taking some of those products which weren't in demand elsewhere, but we could see, for instance, in Colombia, we have a big girder system. We could see a lot of activity for that going forward. So we haven't invested in Colombia, Panama, or Poland. And we've only recently invested a little bit in Singapore after starting that up using existing equipment as well. So it's a combination. But at the moment, the idea of having a low-cost entry model, which I think Adrian alluded to at the start, is to avoid having to spend many millions of pounds of equipment to go into a country to see how it goes. We want to go in and test the water before we then make another decision.
Okay. Probably got time for one more, Kevin. Yes.
Sorry, two, if I can, one very brief one. But the first question, picking up, I was actually very intrigued about the comments that you made, that one of the challenges and margin differentiators was the availability of imported labour in the Middle East and the visa system and all that sort of thing. When you look at what you're trying to do in that business at the moment, obviously in support services, I'm guessing that's as labour intensive, maybe if not more so, than the construction side. Does it ever get to a point where you've actually got to make a decision because of the availability of labour? Is it better to, bid on a new work than it is on try and get a maintenance contract? I mean, I just, in a way, wanted to have some, basis of recognition of how much of a challenge is this issue of actually getting labour into the region.
What we're trying to do is make sure that we have got enough open visas available for any potential work coming in. So CANSAB, for instance, I think we've got another headroom of about another 800 visas before we have to go back to the ministry. So at any one time we try and maintain headroom and make sure that we're replacing any visas that are expiring. And because we've got very strong local partners with strong relationships with the labours of the ministries of labour, we have greater accessibility to visas than I think new starts.
Okay. There's a qualitative issue though here as well. Putting someone to work on a construction site versus putting them to work in a royal palace that is occupied and occupied by somebody who has what they want when they want it in the way they want it, end of story. It's a very different animal. You think just about the way you might think of an electrician working on a construction site versus someone you'd have in your home. Multiply that differential by about 10, and that's the scale of the sort of challenge we've got in terms of sourcing labour. They don't easily transfer across. We've done the retraining bit, and we've decided that's not the way forward, and we'll do it differently.
Well, we've actually brought. I mean, we obviously trade test them in country before we bring them in, but we've actually set up a training school of excellence for our facility services in the UAE, so that when we deploy these people, they're ready to, do the job.
Okay. And the other question is a very simple one. I was a bit surprised. Maybe I shouldn't have been. In your metrics of for RMD, the profitability, etc., there was no differentiation made between hire and sale of equipment. Is that not really a factor these days in terms of the return that you can get in the business, the play-off between the two?
Our preference is always to hire. That's the sort of the long-term revenue generation and profit generation of our business. What we see in our markets is that a customer will either want to buy or want to hire. We will do various things to try and sort of influence the offer we make, so to take it more towards hire. But if a customer wants to buy, we're not going to take ourselves out of that equation, because they will buy from somebody else. So we have different mixes in each of our countries, and that's generally driven by the customer's confidence of how far in the future they can see their workload. Usually more in the commercial sector, people invest more in commercial products. So whilst not necessarily on my sheet, our preference and our sort of built in us is to try and find a higher solution. And then after that, we'll do a sale and we'll offer an automatic buyback to get our equipment back at a lower price as part of a contractual condition. But we can't force the customers to do that. There's plenty of offers out there for them.
So we monitor daily hire.
Yeah, every day.
That's a weekly report we get, daily hire rates by country. Ian is part of a pricing committee that reviews pricing from the centre into the various markets quarterly to try and make sure we're maximising that sort of price elasticity. But it does ebb and flow sort of in countries and between countries, but actually it's netted out every year for the last 10, I think, with one exception, to roughly 50-50 revenue split, hire sale, and roughly 70-30 gross profit split, hire sale. The only exception being 2009, when we had Yas Island there, which was priced fairly generously from our perspective and was a very large and very long-term hire contract. And that skewed, that and the second airport terminal, I think, in Dubai, skewed the results more like 60-40 in favour of hire. But
Okay, thank you.
I'm sure we could carry on all day, but I think we should try and draw things to a conclusion, and perhaps there's some lunch outside. Thanks very much for giving us your time. Our objective today really was to summarise where we are, where we've come from, where we're going to, not just in the context of 2015. The business is going to be around for a lot longer than that, but with a particular sort of focus on what might we achieve by 2015. And I suppose the message we want to leave you with is we've got a lot of growth avenues, organic and inorganic. We've got significant resources available to us, human capital and financial capital, and I think we're doing a lot of interesting differentiable things to drive our business forward. Clearly we'll all be around over lunch, so the Q&A doesn't have to stop here, but if I could just thank you very much for your time, thank my colleagues for their contribution as well, and hope you've had an interesting, useful and informative session. But let's go and grab some food. Many thanks.